The issue, I suppose, that I look at it is that the small business sector in the US does have a bunch of existing lenders. They're called banks.
Yes.
Oh, I'd like the laughing. I think gave the game away there. Although the big, national banks, the big, US-wide banks, obviously don't tend to specialise in spending to small businesses. And I think I saw some numbers from one outfit suggested that the average acceptance rate from a big mainstream bank was about 15% in terms of applications. But there are lots of community banks in America that do lend to small businesses. So surely there's not a gap, is there? Why don't you start with you first, Albert? There must be loads of lenders out there.
No, you're right. And I think we love the idea of community banks, but for a lot of small businesses, again, it's the infrastructure right now. And it's a difficult process. Like I mentioned earlier, it's about 25 plus hours to apply and hopefully get funded for a loan. That takes 3 to 6 months. It's just there's inefficiencies in the system that we can maximize. Also, if you think about the financial crisis, if you think about community banks, they aren't what they used to be. There's a lot less than there were prior to 2009. So both of those things just combined, again, from a risk aversion perspective, the bank examining system, the federal regulators, it's just more difficult than it was for them in prior years. So there's a shyness towards this, call it sub $250,000 loan in particular.
And that's the sort of, you think, the sweet spot, 250,
it's a
200,
massive
150?
Market. I think we target below 500,000. We think there's a massive market in particular below 250.
Below 250. Term, 3-5 years? One?
Ours are 2, 3, 4, and 5 year terms, and we look to be a bank replacement loan.
Median? What's the average? Median, not more?
About 150,000 for us.
Okay. And duration, year or two?
About 3 years.
3 years.
So, and again, that's the key where, well, why couldn't I just put this on a credit card? You can't put $150,000 on credit cards.
Well, I don't know.
Maybe you can in America. But for the most
Depends how big your limit is.
It's unlikely that you can get that far for expansion capital.
Gary, what's your take on this? I mean, aren't you really serving a super served market, and basically you're just going to have to charge more in terms of credit?
Marrying on what Albert had said, I think that sub 250 market really is the core. And when you really think about it, community banks are really not set up to look at the business itself. They're really looking at the business owner's personal financial holdings.
Yeah.
So at that point, they're really making you a personal loan that's dressed up as a
business loan.
Yeah. In terms of the cost, I think that if you're trying to underwrite the business itself, your credit risk has to be commensurate with the risk of the business not being successful, as opposed to just the business owner. And I think that's what's happening here that's new, is that the alternative lenders that are emerging are combining both information, data about the business owner as well as the business itself. That's new.
Yes, absolutely. I was going to put it, Sam, what's your take on this?
Yeah, so I have a slightly different take than that, which I agree with. Yes, it's process inefficiencies, and that's certainly been the case. Community banks are not known for process efficiency, right? So, okay, but as I look at this market, right, I look at it as very different than many things have been talked about today, which is in the consumer product category, particularly for the debt consolidation loan, that is a market opportunity which I believe has cyclical characteristics, okay, meaning the big banks, Capital One, for example, and others, have been in that product category before and have done it and pulled out because of a cyclical retrenchment of risk tolerance, okay?
Absolutely.
Small business lending has structural barriers, right, which is us as shadow banks, okay? We're in a market when the banks cannot or will not address it, right? Because competing with them toe-to-toe in a product category they emphasize is actually difficult, which I think many of us need to acknowledge, which is why you don't see any platforms in prime mortgage lending, right, for example. Because, yes, are we more efficient online? Absolutely. Do we have 10x leverage and the cost of capital they do? No. Right? But small business lending is a structural opportunity, in my opinion, for a variety of reasons, one of which is the process inefficiencies. The other is the extremely heterogeneous nature of the market, right? So the differences between one small business and another are dramatic, to say the least, in terms of risk profile. No collateral. We now operate in a service-based economy. So if you look at the composition of the small business market, 85% of it or so are service-based businesses that have no collateral to offer, right? And so when you couple all of that with the fact that these are really risky businesses to lend to, it makes sense why the majority of the small business market should sort of belongs in alternative lending. So if you look at government data, for example, okay, and you say, look at all the loans that the government has guaranteed through SBA programs over the last 20 years. What do you think the lifetime default rate of that is? I'll just give somebody a guess. What do you think it is? Sir? No? Yeah, what do you think it is? Yeah. Not that bad, about 13, 14%.
Oh, I was going to say about 5 or 9. So,
Right, so I think for those of us that are up here, you have to sort of acknowledge the reason we are addressing this product category is because of, yes, structural inefficiencies of the way they lend, but also risk tolerance,
Yeah.
right? And for the market that we're in, it's very different in the way you underwrite versus a consumer product, which you can generally rely on a couple data sources. You have to rely on a wide variety in this market.
I was going to say, how do you actually price risk? Because I mean, we've heard a lot about FICO scores in the consumer sector. You know, you can in fact take out the FICO score, add a few bits of big data in, and probably get to a number. You can't really do that in. I mean, well, as you said, they're balance sheet poor, aren't they, in many respects? In the sense that there's not a lot of assets sitting around.
So I don't want to hog the panel. So.
Don't worry, I'm going to take it to Jeffrey in a second.
I'll finish this one, then I'll let it. Right. So any business, any lending category where there's no collateral to be offered, right? Our loans are technically secured, functionally unsecured, meaning we file a blanket lien against the business, right? But it all comes down to probability of loss.
Yeah.
Right. So same concept in the consumer debt consolidation loan. You're pricing based on the probability that consumer won't pay you back. It's the same thing in business, except the fact that you have to use so many different inputs.
Yeah.
Because the nature of the risk is so diverse.
Jeffrey, what's your take on that? I mean, it sounds like there's structural impediments to the big guys playing in your space, but also it's like it's damn risky.
Right. So it's and one thing I will just add that's really been good for us in this space. If you look back before the crisis, there were about 1,400 community banks.
Yeah.
So there are about 700 now.
Yeah.
So you're not going to see 700 new banks come in to address this issue. So we're going to be around for a long time. There's also an opportunity, I think, to partner with community banks in the sense of they are geographically, they are structured in a way that they can only reach the region in which they operate. Mm-hmm. And they are attracted to moving out of that area. So they are very interested, even more than the larger banks, of finding ways to reach new customers. And also they're interested in online origination. So we actually have a community bank investing on our platform. Right. Which is when you're starting to see that, it's actually pretty.
And that's interesting because actually, whenever a lot of people talk about the whole sector, they tend to talk about it in opposition to the traditional banking structure. And actually, what you're saying is actually collaboration is probably a better way of doing it. And in fact, that's true in Funding Circle in the UK, which works at Santander. So, I mean, is it a significant proportion of your business coming via those, or are you still independently generating?
No, we as we grow, we've been moving more of institutional investors. So it's they're the bulk, probably 90% of the funding. Yeah. And then the credit investors. So they're just sticking their toe in the water, the community banks. Yeah. So they're not diving in yet, but it's good to see the direction. I think in the next 3 to 3 years, you'll see a lot more partnerships in place. And it's going to be more. I mean, we actually, they don't want the loans that we originate. And so I think it's going to be a great partnership. Once you prove out your model and also your default rate, they'll feel a lot safer about coming in and being a partner with you.
And just on that, again, what's your sweet spot in terms of loans and customer? Are you looking at at sub 250? 3 years territory?
So we start around $10,000 and we go all the way up to $500,000. Our average loan to date is around about $25,000.
Okay, so quite a lot. You're the smaller.
We're the smaller, but we do have a number of companies that are around, $400,000. But yeah, we're doing a lot of small stuff. We do very fast. We try to.
And that's important. It's speed.
It's speed and certainty.
Yes, absolutely.
So a lot of small businesses come. They want to know that one, they can get the financing. They want an answer fast. So we work through a lot of partners. So we offer a 24-hour yes or no. 24. And then we can sometimes fund on the same day, depending upon the size and the complexity, but try to fund at least the next day. And it's that certainty that the small businesses love.
Krista, I'd like to get your take on this. I mean, we talk a lot about, particularly as investors, we talk a lot about cost and yield and that kind of stuff. But actually, Jeffrey's just raised an important, which is, takes Ron raises, is service, brand. Actually, do you find most of the businesses that work with you guys that they only really look at what it's going to cost them, or do they look at all the other factors about speed of decision?
I would say that we are trying to educate them to look at, more than just the price of it. I mean, we're a factoring platform, and so we're very competitive on price as compared to other like receivables lenders. But I think, I had a client, I said to them, here's the deal, and she was like, we're not going to do it. It's just too expensive. We're going to go to the bank and try to do an SBA working capital loan. And I was like, great, no problem. Obviously, we are going to be more expensive, but what we can offer you is a lot of speed, and we know you're growing 50% year on year. We can increase your credit line, like as you grow without, if you get a line from the SBA, you're stuck, right? Until you pay that loan off, you can't go and get any additional funding. And they came back 3 days later and signed the loan, and we've already increased their line 3 times in 4 months. So, I think that ability of all the platforms here, the flexibility we have in being able to offer more capital more quickly to accommodate these businesses as they grow is huge.
And it's a subject we're going to talk a bit about later on in the afternoon when we look at things like receivables funding as well. But actually, we pointed out in the film that there's a whole, businesses, and I run a business myself, businesses don't just want 3-5-year money. I mean, that's important if you can get 3-5-year money, but they want working capital. That definition of working capital can be 3 months, 1 month, 6 months, 12 months, 18 months. Is that where you think that working capital requirement is a real sweet spot?
I mean, we think so. I mean, we thought we were going to go out and be targeting, doing $50,000 loans all day long. And as it turns out, most of our loans, the average size is over $500,000. $500,000. Go up to $2.5 million. And I think the banks so those customers who have kind of $2 to $10 million in annual revenue, they're not getting funded by the banks either. No. They're not getting enough capital to maintain. They're usually in a really high growth phase. And we see crowd lending as just a great model for them, because so we'll take a $2 million credit, and a bank will look at that and say, well, we don't want to take $2 million worth of risk. But if I can spread that $2 million of risk amongst a number of investors, that starts to be something that's great for the business and giving a really good yield to the investors in the loan.
Tabitha, again, is it really just about the hard numbers, the cost of borrowing, or is it actually about all the other factors?
Well, we think that's one of the most interesting opportunities for these platforms like ourselves, is that you go way beyond, you were asking about FICO scores on the personal side. Small businesses, when you talk about working capital, the majority of them are cash businesses to begin with. Yeah. So you can't look at a balance sheet. No. You can't look at an income statement. No. As soon as you do, you see that, amazingly enough, I'd say 95% of small businesses lose money or make about $20,000 at most, right? Yeah.
That's after the dividends, isn't it?
Exactly. Right? So we think that there's real opportunity to look at the cash side of the businesses and to fund based on the cash that we see coming in. Yeah. Right? Starting to look at the owner's sources of cash, the business's sources of cash, the kind of business. There's a lot more predictability when you actually strip away all of those layers and start to see, well, what kind of relationships do the businesses have with their own existing sort of credit sources, with their own existing ways of using cash and deploying that as a much more interesting and predictive model for risk management.
And talking of risk management, we had a question actually emailed in just now. Can we quantify how risky it is? If you're an institutional investor looking at this space particularly, I mean, what numbers should you put into your model? I mean, we talked a bit about the business cycle a bit earlier. I mean, given where we are now and interest rates are likely to possibly go up a bit, I'll ask all of you this, what should we expect to happen next? So a $64 million question, I should say.
You mean, so what's the magic number that absolutely everybody should say
exactly.
Yes to? Well, here, let me set that for all of us. I mean, I guess it depends on how much of a yield hog you're trying to be to begin with, right? Yeah. So, I mean, it's classic. What's your cost of capital? What's the yield that you're going for? And then what's the default that you're likely to see? But I think generally what we can see is we can control a lot of the default and the delinquency issues when you do start to help the businesses, which is something the banks can't do and we can do, manage cash, right? So whether it's factoring or whether it's using POS-based repayment structures, there's lots and lots of ways that we can start to de-risk for institutional investors as well as retail investors by being able to put structures in place that allow the businesses to pay those loans back much more easily and as an organic part of the business that they're already doing.
Krista, same question to you. Well, I mean, just how risky is it?
I have I'm certainly not qualified enough to answer that. What I will say is that I would agree with what Tabitha just said, and I would add that I think that there's a lot of interesting technology that helps us manage the risk, right? So now that we can go into people's QuickBooks and get real-time data about how their business is performing and make adjustments accordingly, I think that's going to be a huge game changer, and I don't think the banks are anywhere near being able to do that from a technology perspective, and I think that's going to give all of us a huge advantage.
Jeffrey?
Yeah, the main thing is setting up your credit.
Yep.
You know, a lot of, you see some platforms that come into this, and it's more about how much data can I get, and let me try to make predictions based on something no one else has ever used, which in some cases may be good, in some cases may not make a lot of sense. We tend to focus a lot more on traditional. Like our chief risk officer, you know, ran a $4 billion book for CIT. So we're looking at what historically has worked. We'll look at the new items also, and over time we'll be able to make even better predictions. But we try to keep it more traditional and have a lower default rate.
Yeah, sure. So I'm going to say it again. I think small business lending is dramatically different than consumer. Okay, so I personally don't believe that a pure play marketplace model is necessarily right for this market, right? Because there's two ways to compensate for risk here. One is product structure, which I think sort of version one of small business lending was product structure. It was very short duration, very high PR. So therefore you could compensate for risk through product structure, and therefore it was more about selling the product. The other way to compensate risk is to be a skilled buyer or a skilled originator. And unfortunately, as I look out in the market, I don't, first of all, the data sources that are being utilized are relatively new. And secondly, you need someone that has been an expert in using at least some of them to develop an underwriting model that's capable of managing that risk. And I think unlike in what's happening in the consumer market where it's fairly homogenous and it's really about exposing a couple dozen attributes about a customer and they can determine what I want to buy, it's completely different in the small business market, which is why I think a sort of discretionary model like ours is more appropriate.
I'm fascinated because I mean, people have been lending. We've talked about them, you know, for many years.
When you're in the trough of the credit cycle, you can put money out.
Yeah, exactly.
Right.
So why is it? I mean, people have been lending to small businesses for decades. I mean,
right. So I think within the banking system, and maybe this echoes some of what these guys were saying is, yes, there's process inefficiencies, but a lot of times they will lend to a customer to maintain a relationship. So, you know, they want to keep all the other activities they have in-house and whatnot. But as the SBA, in my opinion, came to exist because of the things I outlined before, which is the riskiness of this product category.
We've been here before.
And therefore, without a guarantee, the banks or anybody else wouldn't lend to these customers. So it's why I think that, you know, you sort of need to have, you know, a very skilled risk management function to be able to participate in this market.
But I mean, but surely the logic of that, and I'll just ask you to take your take on this, Gary. But therefore, you shouldn't really be doing it just online, because I mean, you should really be doing it in person.
No, so I think you're making a different point, right? So I'm suggesting that the nature of the inputs that are utilized in an underwriting process are sort of evolving as we speak in our market. I think that unlike in consumer, in small business, the advantages in underwriting are there for the taking for alternative lenders versus the banking system. Because many of the data sources that we're using have come to market in the last several years, and they're very sloppy and they're very messy in the way they're delivered, except for PayNet. I know Bill's here. So. And so anyway, sorting through that messiness will ultimately create value for your company, right? So in my opinion, maybe you can tell I have a number of opinions by now. What's going to drive value in this market for any of us is really a couple things. One is low cost and scalable cost of customer acquisition, and the other is low cost and scalable underwriting and ability to manage that across a credit cycle. Whether you fund that loan through a marketplace or a balance sheet model is of secondary importance. And I think many of us have sort of started to grow up at the trough of a credit cycle. Therefore, we have a lot to prove. And I don't know that there are many institutional investors out there that have lent to businesses using a data-driven approach where they can say, I'd like the orange one and the red one, and you can keep the green ones for someone else. So it's why we decided to adopt more of a balance sheet-driven model, at least for now, in this product category.
And I want to pick just with you two gentlemen here at the very end, Gary particularly, is just interesting you said that we want the green one, the yellow one, and a bit the red one. But surely that is exactly what's going to happen, isn't it? You are going to get institutional investors come along and they're going to go, we'd like a bit of that C plus, a bit of the C minus, and a little bit of D and E, and we'll mix it together and we'll get a blended yield.
I think it actually goes further than that. I think at the end of the day, the institutions are going to be the ones who design the box.
Yes.
So instead of an originator going out and finding a whole net of loans, bringing them in and hoping that some of them stick on the wall, what you're going to be doing is you're going to be originating specifically to meet the needs of an institution's box, and that box is going to be a function of basic criteria we see in all fixed income investing, which would be what's the tenor, what's the term, what's the average life, how in this business how frequent are the payments, which in most loan products that go out for longer periods of time, the frequency of payment maybe isn't that important. Here it's really important. The primary way, as Sam was talking about, mitigating risk through structure. I mean, the primary way that the alternative finance market first started to attack the lack of small business credit was through daily remittance. So they were getting paid every day. So if you get paid every day, either out of the credit card machine or taking it out of the business owner's bank account, you mitigate a lot of risk because you're getting paid all the time. And some of that is return of capital, some of that's going to be interest. So it's not just the rate. The rates obviously are higher as you take on these riskier businesses that banks traditionally has shunned. But that structure, I think where it's going to get very interesting is where the terms go out longer, because I think that's where you have the greatest unknown. Yeah. And I have looked at, PayNet does have a fantastic source of data, but their probability default typically is focused on what happens inside of 2 years, which we think is a very relevant time period for many of these borrowers. But there are investors who are looking for 3 to 5 years.
3 to 5 year money, yeah.
And there probably are also borrowers who are looking to go out that long. I think that's where where there's the greatest unknown is when you start to go out to these longer time periods with a monthly payment model, not clear what those loss rates are going to look like.
Very last point, Albert.
Well, and that speaks to the type of customer that anyone's targeting, and I think you have to charge rates appropriately depending on the customer you have. But again, if you're looking for a true bank replacement customer, that high quality customer, they don't want necessarily the product that some of these other get offered. They want that 3 to 5 year term loan. That's what we're targeting. I think the most important question you can ask as an investor to anyone up here is, how are you doing your underwriting? Walk me through it. Yeah. And you should do that with every single one of us. Something that we're very proud of because of the loan size we target. It's important to have human overlay. It's very scalable. We've done it successfully in the UK for the past 4 years. We're doing it here for the past 2 years. Technology can help you, but as Sam mentioned, data is great. That helps build the scorecard and the framework, but at the same time, for key loan sizes, for true expansion capital size loans, you need to spend time with these borrowers because, again, there isn't just a box that says, this is exactly going to always work and this one is not. So for us, we're very proud to have seasoned underwriters that have worked at banks, humans talking to humans. That's part of the experience that these borrowers want as well.
Old-fashioned concept, humans. Thank you very much to the panel. Give them a round of applause. And we're just going to now lastly hear from Gary, who's going to give us a...